Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of corporations. Today we're diving into a report from Cross Country Healthcare. It seems like there might be a bit of a delay on a big deal they're trying to make. Let's see what's going on and if it will affect you, or more specifically, your pocket. This report is called an 8K. Companies file these to let investors know about big changes or events that could affect the company. Think of it as an uh-oh moment or sometimes a yay moment depending on the news. Scroll date of report date of earliest event reported. Span, CAD equals sign, XDX_90, E_ADEC document period, end date _C, 20250220__20250220_ZIN, 7 D-date non-numeric context ref equals sign as of 2025-0220 format equal X date month day year ID equals sign fact 00000 name equal day document period end date February 20th 2025 seed non-numeric seed span seed scroll. The earliest event discussed happened on February 20th 2025. So we're getting a pretty up-to-date snapshot of what's happening with Cross Country Healthcare. Cross Country Healthcare Inc. is the company we're talking about today. They're in the business of providing healthcare staffing solutions. That means they help hospitals and other healthcare facilities find nurses, doctors, and other medical professionals. This little checkbox being marked means they might be asking for your vote or soliciting materials for something. This scroll entered into an agreement and plan of merger. The circled merger agreement, this circled, this scroll. Okay, here's the main point. Back in December, Cross Country Healthcare agreed to merge with another company called Aya Healthcare. This merger is basically a joining of forces. They hoped it would make them stronger together. But like any big deal, there were conditions that had to be met. One big one was getting approval from the government, specifically making sure it didn't break any antitrust laws. Antitrust laws are there to stop companies from becoming too powerful and controlling prices. This law, the Hart-Scott-Rodino Act, requires companies to notify the government before merging so the government can check if it will hurt competition. So scroll company surviving the merger as a wholly owned subsidiary of parent and a wholly owned indirect subsidiary of Aya. This goes scroll. In the end, Cross Country would become part of Aya Healthcare, essentially a smaller piece in a bigger pie. There's scroll. The company and Aya each received a request for additional information. The DB second request, SAD BB second request. That says scroll. Here's the snag. The government through the Federal Trade Commission or FTC wants more information. They've sent what's called a second request. This is like the government saying, hold on, we need to investigate this further. Scroll. Issuance of the second request extends the waiting period under the HSR Act. This scroll. This second request is a speed bump. It extends the waiting period, meaning the merger can't happen yet. They have to give the FTC the information they want. The waiting period is pushed back until 30 days after both companies fully give the FTC what they're asking for. Of course, the FTC could always say yes earlier or extend the waiting period even longer. Because of this, the company now thinks the merger will happen later than expected, most likely in the second half of 2025. There are still a few other hurdles to jump to. Stockholders, meaning the people who own shares in Cross Country Healthcare, have to approve the deal and other conditions need to be met or skipped over. Scroll, investors and security holders of the company are urged to read the definitive proxy statement. The scroll. The company is urging its investors to read a document called the proxy statement. Think of it as an instruction manual for the deal with all the important details. Scroll their ownership of company common shares and the company's transactions with related persons. Scroll. These documents also provide information about who owns the company shares and any deals the company has with people connected to it. Full scroll is not intended to and shall not constitute an offer to buy or sell or the solicitation of an offer to buy or sell any securities. Scroll. This part is just saying that the report isn't trying to get you to buy or sell any stock, it's just providing information. Full scroll, this communication contains forward-looking statements within the Private Securities Litigation Reform Act of 1995. Scroll. Now here's a very important section. It's basically a disclaimer that says the company is making predictions about the future, but those predictions might not come true. For example, they're making predictions about when the merger will happen and how much money stockholders might get. Scroll, difficult to predict. Such risks and uncertainties include, among others, the timing to consummate the proposed merger. Scroll, the company lists many things that could go wrong, like delays in getting government approval or stockholders not voting for the deal. Scroll, the risk that competing offers will be made, unexpected costs, charges or expenses resulting from the merger. Scroll, they also mention the risk of other companies making competing offers or unexpected costs popping up. Scroll, or political changes that affect the markets that the company's businesses serve, which could have an effect on demand for the company's services and impact the company's profitability. Scroll. Other possible risks involve changes in the economy, global health, changes in technology, or changes in consumer behavior. Scroll, claims and investigations. Accordingly, actual results may differ materially from those contemplated by these forward-looking statements. Scroll, all of this means that what actually happens could be very different from what the company expects. The company also says they don't have to update these predictions even if things change. So, what does this all mean? Well, the merger between Cross Country Healthcare and Aya Healthcare is facing a delay. The FTC wants more information, and that's pushed the timeline back. There's no guarantee the deal will go through as planned or at all. It's like planning a wedding and then getting a call from the health department saying they need to check out the venue. From an investment point of view, it might not be wise to buy stocks now and hope for a quick return. If the merger falls apart, the stock price might drop. On the other hand, the company could continue to grow and do well on its own, and the merger could still happen in the future. Cross Country Healthcare has a long-term record of growth, and it has managed to become a leading provider of healthcare staffing services. But a possible weakness may be that the company relies on economic growth. If there is an economic slowdown, the company may not be able to meet targets. This looks like a somewhat risky situation. Based on current information, a reasonable price range would be somewhere between $20 and $24, but the price could change depending on new information. Overall, my opinion leans cautiously towards neutral, possibly even bearish. The delay in the merger adds uncertainty, and it might be better to wait and see what happens before making any big decisions. Thanks for watching. If you found this helpful, please subscribe for more breakdowns of corporate news and finance.